Let me tell you a secret. Price action and candlestick psychology is what separates the true market masters from the rest. You see, every candlestick on your chart is a visual representation of the decisions made by thousands of traders, each acting on their own beliefs, fears, and expectations. Well, candlestick psychology is about understanding that the market is not just a series of random candles, but a reflection of human behavior. So let's talk about it. This is how I personally read each candle. A long candlestick, also called a trend candle, whether bullish or bearish, represents a significant imbalance between buyers and sellers during that time period. The length of the candle body reflects the intensity of this imbalance. A long bullish candlestick forms when the closing price is significantly higher than the opening price. In terms of supply and demand, this indicates that buyers were in complete control during this period. They aggressively bid up prices, absorbing any available supply. The lack of upper wick suggests that buyers remained in control until the very end of the candle, with the closing price near the high. This type of candle often signals strong bullish sentiment. Buyers are confident and willing to push prices higher. It can potentially indicate the start of a new uptrend or the continuation of an existing one. The psychology here is one of optimism and aggression from the buyers. On the flip side, a long bearish candlestick forms when the closing price is significantly lower than the opening price. This indicates that sellers dominated the session, aggressively pushing prices lower. The lack of lower wick suggests that sellers remained in control until the close, with the price ending near the low. This type of candle signals strong bearish sentiment. Sellers are confident and in control, potentially indicating the start of a new downtrend or the continuation of an existing one. The psychology here is one of pessimism and aggression from the sellers. A short candlestick, whether bullish or bearish, represents a period of relative balance between buyers and sellers. The small size of the candle body indicates that neither side was able to gain a significant advantage during that time frame. From a supply and demand perspective, a short candlestick suggests that the forces of buying and selling were largely in equilibrium. This type of candle often indicates a period of indecision or consolidation in the market. Neither buyers nor sellers have a clear advantage, leading to a relatively narrow trading range. The psychology here is one of uncertainty and caution from both sides of the market. When a series of short candlesticks appear, it may show declining momentum in the current trend or be a symptom of sideways movement. A doji candle forms when the opening and closing prices are virtually equal. This means that despite any price fluctuations during the period, buyers and sellers were ultimately in balance, neither side being able to gain the upper hand. From a supply and demand perspective, a doji represents a moment of indecision, a pause in the ongoing war between buyers and sellers. As the candle opens, buyers attempt to bid prices higher, while sellers attempt to drive prices lower. Over the course of the period, neither side is able to maintain a significant advantage. Every advance by the buyers is met with equal selling pressure, and every decline instigated by the sellers is met with equal buying support. This back and forth results in the price oscillating around the open, ultimately closing at or very near the same level. From a psychological standpoint, a doji suggests that the market is at a crossroads. The previous trend, whether bullish or bearish, has lost momentum. Market participants are reassessing their positions, reevaluating their convictions in light of new information or shifting market dynamics. This moment of collective hesitation can be a precursor to significant market moves. Candlesticks with long upper and lower wicks on both sides of the real body represent a period of significant volatility and indecision. As the candle opens, buyers push prices higher, as indicated by the long upper wick. This shows that there was significant buying pressure during this period. However, at the higher prices, Sellers stepped in aggressively, driving prices back down. The long lower wick shows that sellers were able to push prices significantly lower. But here, they meet strong opposition. Buyers re-entered the market at these lower prices, bidding prices back up. This back and forth between buyers and sellers continues throughout the period, resulting in a relatively small real body, which is the difference between the open and close, compared to the total range of the candle, which is the distance from the high to the low. From a psychological perspective, these candles indicate a market in a state of high uncertainty and indecision. Neither buyers nor sellers are able to maintain control for long. The long wicks on both sides suggest that both bullish and bearish sentiment is present, but neither side has a clear advantage. This type of price action often occurs at key turning points in the market or after a prolonged trend. It signifies that the previous trend is losing momentum and that a shift in market sentiment may be underway. Candlesticks with a long upper wick and little to no lower wick can signal a potential shift in market sentiment and supply-demand dynamics. As the candle opens, buyers are in control. They aggressively push prices higher, extending the uptrend or rally from the previous periods. This buying pressure is reflected in the long upper wick, which shows the highest price reached during the period. As prices reach these levels, sellers begin to emerge, stepping in to take advantage of what they perceive as overextended prices. They start to outweigh the buyers, creating selling pressure that drives prices back down. From a supply and demand perspective, these candles indicate a potential exhaustion point. At the higher prices, supply begins to outweigh demand as more participants view the price as overextended and look to sell. This shift in the supply-demand balance is what causes the price to fall back from the highs. Psychologically, these candles can signal a potential change in market sentiment. The long upper wick suggests that the bullish momentum that drove prices higher is decreasing. It's a visual representation of a buying exhaustion, the point at which the upward trend loses steam, as fewer buyers are willing to push prices higher. The candlestick with only a long lower wick can also signal a potential shift in market sentiment. As the period begins, sellers are firmly in control. They aggressively push prices lower, extending the downtrend or decline from the previous periods. This selling pressure is reflected in the long lower wick, which shows the lowest price reached during the time frame. However, buyers are sensing an opportunity in the oversold conditions, and they start to step in. They begin to outweigh the sellers, creating a buying pressure that drives prices back up. From a supply-demand perspective, these candles indicate a potential exhaustion point in a downtrend. At the lower prices, demand begins to outweigh supply as more participants view the price as undervalued and look to buy. This shift in the supply-demand balance is what caused the price to rebound from the lows. Psychologically, these candles can signal a potential change in market sentiment. It's a visual representation of a selling climax, the point at which the downward trend loses steam as fewer sellers are willing to drive prices lower. Gap candles reflect dramatic shifts in overnight sentiment and supply-demand dynamics. An up-gap candle occurs when the lowest price of a candle is higher than the highest price of the previous candle. Visually, this leaves a blank space or gap on the chart. Psychologically, an up-gap candle suggests a significant shift in sentiment in favor of the buyers. It indicates that buying pressure has intensified dramatically to the point where sellers were unable to drive the price down to the level of the previous close. It could reflect a more gradual shift in market psychology, where a critical mass of buyers has decided that the current price is undervalued. Either way, the up-gap signals that demand has suddenly outpaced supply, and that the balance of power has shifted decisively in favor of the buyers. This can serve as a powerful signal to look for buying opportunities, as the increased buying pressure could lead to further upside momentum. A down gap candle occurs when the highest price of a candle is lower than the lowest price of the previous one. Psychologically, this suggests a significant shift in sentiment in favor of the sellers. Selling pressure has intensified dramatically to the point where buyers were unable to drive the price up to the level of the previous close. It could reflect a more gradual shift in market psychology, where a critical mass of sellers has decided that the current price is overvalued. This increased selling pressure could lead to further downside momentum. Also, gap candles don't always lead to continued movement in the direction of the gap. A gap candle can be a signal of exhaustion, where the move has pushed the price to an unsustainable level, leading to a rapid reversal. This is why many traders pay close attention to gap fills, instances where the price moves back to fill the blank space left by the gap. Now, very important, we're often tempted to react immediately to a single dramatic candle. For example, you're watching a market that's been in a steady uptrend, and suddenly, a massive candle appears, much bigger than the previous candles. It's a bearish, compelling pattern, no doubt. But here's the thing, the market is a complex, noisy place. At any given moment, there are many factors influencing price action. A single candle, no matter how dramatic, is just a snapshot of a very brief period of time. It doesn't tell the whole story. That single dramatic candle, it's worth noting, but it's not enough on its own to base a conviction on. You need to gather more evidence. This is a critical lesson for all traders to learn, but especially for beginners. The market has a way of generating all sorts of dramatic, compelling signals on a minute-by-minute basis, and it's easy to get caught up in the excitement, to feel like you need to react to every candle. But the successful traders, the ones who last in this game, know better. They know that the real edge comes not from reacting to every signal, but from patiently waiting for the high-quality setups. That's why in the future videos, I plan to talk about the psychology of support and resistance levels and how to combine them with candlestick analysis. And in the meantime, go ahead and watch one of these price action videos.